All right, let's tackle the question that trips up a lot of investors, even the pros. Can a truly legendary, world-class company actually be a bad investment? The short answer is yes, absolutely. And knowing the difference between a great business and a great stock price, that's the key to smart, disciplined investing.
And the perfect case study for this, you guessed it, Berkshire Hathaway, an absolute icon of success. So you'd think its stock is a no-brainer, an obvious buy right now, right? Well, the answer might actually surprise you. Let's walk through a professional framework and see what the data is really telling us.
Look, before you even think about buying a stock, you need a system. You have to, because emotion and a company's reputation, they can be traps. So we're going to use a disciplined 3-point checklist, the same kind of process the pros use, to screen for opportunities based on data, not hype. This is how you stop guessing and start assessing.
So here it is, our checklist. It's simple, but it's incredibly powerful. First, the Zacks rank. What are the other analysts thinking? Second, trading volume. I mean, can you even trade it effectively? And third, insider buying. What is the smart money, the people who run the company, actually doing? Let's run Berkshire Hathaway through these 3 simple tests. First up, the Zacks rank. This is all about what professional analysts expect from earnings. We're looking for a #1 strong buy or a #2 buy. Berkshire Hathaway, it's currently a #3, which is a hold. Now, it's really important to understand what hold means. It doesn't mean it's a bad company. Not at all. It just means that analysts believe it's pretty much fairly valued at its current price, so there's no big upside expected anytime soon. So on our very first test, it fails. And here's why that number is so critical. If you look at the historical data, Zacks rank #1 stocks have returned over 23% a year. That's more than double the S&P 500. A #3 rank, like Berkshire's, has historically returned just over 9%. That's actually underperforming the market. The data is telling us there are probably better places to find growth right now.
Okay, criteria number 2 is all about liquidity. Basically, can you actually buy and sell this thing easily? To build any kind of serious position, we need to see an average daily volume over 50,000 shares. Berkshire's a Class A stock, it trades about 400 shares a day. Its giant price tag makes it one of the most illiquid megacap stocks on the planet. For any serious investor, that is a huge problem. So that's our second failure.
And now for the final, and maybe the most telling signal of them all. Insider buying. Are the executives, the people who know the company inside and out, buying their own stock with their own money? For Berkshire, the answer isn't just no, it's the exact opposite. They are net sellers. That's a huge red flag. Our third and final test is a clear fail. So let's recap. Berkshire has failed all 3 of our criteria. But this isn't just about numbers on a screen. These red flags line up perfectly with what the man himself, Warren Buffett, has been doing. His actions tell a very, very clear story.
And I mean, let's get specific here. For 12 straight quarters, that's 3 years, Buffett has been a net seller of stocks, getting rid of tens of billions of dollars worth. And here's the real kicker. The company's own stock buyback program, which is a huge signal of confidence from management, has been on pause for well over a year. These aren't opinions, folks. These are actions backed by billions of dollars.
So why? Why stop buying back your own stock? Well, Buffett told us, plain and simple. He believes the shares are trading at a 60 to 80% premium to their book value, which is basically the net worth of the company. Think about that for a second. The takeaway is just stunning. The world's greatest value investor thinks his own company's stock is too expensive to buy.
So this all begs a bigger question, right? If Buffett isn't buying his own stock and he's selling other stocks, what on earth is he doing? The answer is hiding in plain sight, right inside Berkshire's bank account.
Get ready for this number, $354 billion. That is the mountain of cash and short-term T-bills that Berkshire Hathaway is sitting on right now. And just to put that into perspective, that is the largest cash pile in the company's entire history.
Now, in the investing world, we have a name for this. It's called dry powder. It's cash you keep on the sidelines ready to go so you can jump on great opportunities at great prices when they finally show up. So what's the message here? It's crystal clear. Building up a record amount of cash is a direct signal from Buffett that he thinks asset prices, pretty much everywhere, are just too high. He is patiently waiting for things to get cheaper. At these levels, he's choosing cash over stocks. So where does that leave us? Let's bring everything we've talked about together and make the final call. And this, right here, is the absolute key to disciplined investing. On one hand, yes, Berkshire is a world-class business. It has a balance sheet like a fortress. But on the other hand, as an investment today, it's just not that attractive. There's no catalyst from analysts, there's no buying pressure from insiders, the valuation seems high, and the liquidity is terrible. You have to be able to separate the quality of the company from the attractiveness of its stock price.
So, following this framework, the professional recommendation is really straightforward. If you already own it, it's a hold. If you're looking to get in, the disciplined move is to stay on the sidelines, at least for now.
But look, this isn't a sell it and forget it situation forever. Things change. So what should you be watching for? Well, here are the signals that would turn this thing into a buy for us. First, the Zacks rank improves to a #1 or #2. Second, management starts buying back stock again in a big way. Third, the stock price drops to a more reasonable valuation. And of course, the big one. We see Buffett finally start to use that massive pile of cash.
So, I'll leave you with this final thought. The data, our professional framework, and Warren Buffett's own actions, they all point to the exact same conclusion. He is patiently waiting for a better price. So, the real question you have to ask yourself is, why would you rush in when the world's greatest investor is not?